Welcome to Yield Nerd, an educational show about how you can acquire and manage yield. Now that we have talked about the risks of preferred stocks, let's talk about the types of preferred stock, and there are many different types. The very first one we're going to call the cumulative preferred stock, and here is what it simply means. It says, hey, I may miss a payment here or a payment there, but I'm going to be good to you. If I miss a payment, I will come back at a later date before the maturity of the preferred and pay the missing payment plus the future payment plus an interest. How nice of this. So in this simple example, let's say that you bought the preferred stock for $25 and I told you I was going to give you a 50-cent coupon every quarter. I gave you my 50 cent for Q1. I gave you my 50 cent for Q2. Times are hard. My company didn't make enough. We didn't issue preferred dividends. We didn't issue common dividends. Another quarter goes by. Boy, it is still tough. We didn't issue preferred dividends. We didn't issue common dividends. And when I'm ready and I've turned my company around and there is now free cash flow, I will pay you back the missing coupon payments plus this coupon payment plus interest. That is called a cumulative preferred. As you can imagine, if you kind of sort of have a greater comfort that you will make your coupon payment sooner or later, that's a lower risk than the typical preferred stock, the non-cumulative. So yields tend to be lower in a cumulative preferred stock. So let's go to, well, first of all, I apologize. I do want to remind you at the end of the maturity of a cumulative preferred stock, you will get your $25 back, very much like a bond. So you buy the bond, you get your par value back, you get your coupons in between. The cumulative preferred gives a little bit of leeway for the company to withhold payments in certain quarters, but then pay it back with incremental interest. So that's what the cumulative dividend is about. Now, if there is a cumulative preferred, you guessed it, there is a non-cumulative preferred. The non-cumulative preferred says, hey, I'm a very nice person, you should trust me. I'm going to do my best. I got all these big common shareholders. They're not going to make a nickel unless I pay you first. You should know I fully intend to pay you. And because, it's not a certainty that the dividend is cumulative, I might even pay you a little bit higher coupon. Once again, you buy the preferred for 25 bucks. Now, instead of 50 cents, maybe you get 90 cents a quarter. And you got your 90 cents for the second quarter. Oops, financial distress. Or I want to reinvest my monies. I did not pay my common shareholders. I did not pay you, the preferred shareholder, as well. I'm working hard. Oops, another quarter where I couldn't pay you. I'm working hard. Now I'm ready to pay you. Realize I do not owe you back the coupon payments of the 2 missed quarters because this is non-cumulative. I do come through and I pay you this quarter. The cumulative preferred stock matures and I pay you back your $25. That's the non-cumulative preferred stock. Let's go to the next one. And I like this one because it has a lot of flavors to it. And this is the convertible preferred. And you may remember we briefly touched upon this where you turned in your lobster eggs and you got a share of the giant lobster. And that's what the convertible preferred is. What this says is I'll pay you a coupon, cumulative, non-cumulative, whatever it is. I'll pay you a coupon until maturity. But when you hit the maturity date, you can actually convert your preferred stock into a stock in the company based on certain parameters. Now, a couple of things have to be true to do that. So let's look at an illustration. You pay $25 for the preferred stock, and I'm going to pay you a coupon of 30 cents, and things are good. I keep paying you. And now that I'm done with my 5 quarters, you are expecting me to give you that $25 back, but I'm going to say, wait, this is convertible preferred, and there are 2 varieties within here. One of them is you have the option of converting, and the other one is the issuer has the option of converting, but we're going to leave that out for a second. And in this scenario, you don't get the $25 back. Instead, your $25 becomes a certain number of shares in the company if the share price is above a certain number, or it becomes a different multiple of the shares of the company if the share price is below a certain number. Or it might just go pro rata if the share price is in between those two parameters. So the convertible preferred is a way for you to get your coupons and kind of pre-purchase the conversion into equity at a future date. And we'll dive deeper into this because there are some very interesting things to look at as we get deeper into this. The next one I want to call your attention on, the next kind of preferred stock is called a callable preferred. A callable preferred, you may remember in the world of bonds, calling means the issuer says, I don't want to keep paying you the coupons anymore. I'm just going to buy it back from you at par value. Well, preferreds have the same scenario where the issuer gets to say, I don't want to pay you preferred dividends anymore. I'm going to buy it back at par value or something close to par value. So you buy the preferred stock for 25 bucks. I pay you the Q1 dividend. I pay you the Q2 dividend. And I decide I don't want to pay you the Q3 dividend. Instead, I'm going to pay you the $25 back. See you later. I am done. That's the callable preferred stock. The coupon itself has variance. What do I mean by that? This introduces another scenario where you pay $25 for the preferred stock. There are 5 quarters. You get your $25 back. In scenario 1, it is what we call a fixed coupon. You know you're going to get 50 cents a quarter every quarter until maturity. That's the fixed coupon. The second one says, well, it's fixed for the first quarter, but then after that, I'm going to give you 1% above the federal funds rate or the LIBOR rate. That's the variable coupon preferred stock. And then there is a third one called floating. It says, I have no idea what it exactly is going to be, but it'll always be LIBOR plus a certain percentage. So if the LIBOR goes up or down, you kind of will see things moving up or down. And so these are all ways for the issuer to retain control over how much cash goes out of them. And we will again dig deeper and understand what kind of things you're buying and when it makes sense so you can be an educated yield nerd. The last part is called the trust preferred stock. And I'm not going to go too deep into trust preferred stocks for the simple reason that it's mainly there for tax purposes. So in order for you to get better tax treatment, instead of buying a preferred stock, which may be considered a short term or an ordinary income, the trust kind of shields you from that and it gives you some level of long-term income. All of this is available and discussed in much greater detail in that citation I gave you, digging deeper into the US preferred market. With that, we're going to conclude this part of the episode on preferred stocks and get ready to dive much, much deeper. Let's get going. Thank you. Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.